Hello, this is Steve Malone with Compass FX. I hope you're doing well today and you're getting some good trades. Today we've seen the Federal Reserve maintain the overnight interest rate of the US dollar at 0.25%. Interestingly, they have a goal of increasing the interest rate once the unemployment rate hits 6.5%. This is unprecedented. We've never seen in the history the Federal Reserve tying the Fed funds rate to the unemployment rate. But this is a new twist as they continue a dollar weakness policy. Now, what has this done to some of the currency pairs? They've caused them to continue making strong movements. We've seen the euro dollar move higher, the pound move higher, the Aussie dollar move higher, the dollar Swiss move down more, strengthening the Swiss franc, which the Swiss National Bank doesn't want to see happen. And we've seen the dollar yen rise. Of these major pairs, I suspect that we're reaching levels of a very strong retracement level if you're familiar with the Fibonacci retracement tool. I do believe that there's a potential for someone to keep on moving in the direction they've been moving, especially the dollar yen. So let me show you what I see in the marketplace. If these strong retracement levels hold, then I look for a turn in some of the pairs. Let me show you what I'm talking about. Grabbing the Fib retracement tool, go from the high to the low, and I've added to my Fibonacci retracement tool the 786 and the 88.6. These are two pretty significant levels that oftentimes we look for the market to retrace once it's reached that level. As a matter of fact, we can see today that with the euro dollar, it pushed up here to the 88.6, two pin highs right here, and then we've seen a drop back below the 786. So in order to see this start to turn and move south, we're going to have to see lower closes, continual lower closes, which would bring us down back towards the 50%, maybe even the 38.2%. Some expect that the possibility to see the euro move all the way back down to the December 6th low here, right around the 128.80 area. Now, if we do break higher and this doesn't hold, some in the marketplace are looking for a push up to 131.70 level. The reason for that is when you go out to the daily chart, that's the high that we had back in September. We sort of have a triple top going on right here. Market tried to push down, then push back up to it. Hasn't seemed to get any higher, but if we break above this level here and take out the 31.70 level, then we start looking at some weekly levels. So let me go to the weekly chart. And here we have some weekly levels going back to this level here back in April, and then we have back in March, and then the high of the year going back to late February. And you can see that these levels are around 32.80, 33.80, and then all the way up to about 34.85. I really don't see the market pushing up that high at this point, given the fundamentals of the Eurozone. However, if we continue on this path of dollar weakness, there could be an attempt to get above 131 and attempt up to 132 before we start seeing some movement back down. Again, going back to the 4-hour chart, if the market doesn't get beyond the 88.6 or the 78.6 level, I look for that move back down. This has been a very strong run to the upside, and I can see kind of a 1, a 2, and then a 3 move up. We could stay range bound up and down this area, but if we don't get beyond the 131 level, I do see a retracement back. Now take a look at the pound dollar. Similar situation here today. The pound dollar has moved up today at got up to a high of 161.73. That matches these highs back here. Not quite yet at the 786 or the 88.6. I suspect there could be a potential move on the pound overnight up to 162. We're fairly close to that. If the 162 holds, that'd be a 786 failure, and we see the drop back down. If we climb higher, then the 88.6 puts us right around that 62.50 area. On the Aussie dollar, you can see that the Aussie dollar, based on the FOMC meeting today, pinned high right up and through, but closed below right now of the 88.6, which is around that 568, 570 area. Some are anticipating a potential push higher. However, interestingly, taking a look at some of the options in the marketplace, most of the Aussie dollar options are posted down around 105, 104, 103.50, and 103. So going out further in time, looking at the weekly chart here, you can see that the Aussie dollar has been tightening down and tightening down. You can see right here it doing that, coming across right like so. Let me get this set right off that high. So we're coming up pretty close to this trend line high, which sits right underneath that 106 level. Many market participants are looking for a bounce off this trend line and a push lower. Where to? Well, back down on that daily chart, we can see that if we do get a push back down, I look for the levels right around the 104.40 area, which has been a significant level that when the market gets above it, it pushes higher. When the market gets below it, we seem to sink down. The 50 level sitting here at about 385, 38.2, around 320. 23.6 puts down around the 102.60 area. We'll have to see what the market does when it gets back down in this area. Take a look at the Swissy. We've seen the Swiss also, like the Euro, push all the way back towards the 88.6. You can see right now it's bouncing between retracement from this low to this high, bouncing here right off that 88.6. Again, the Swiss National Bank not looking for a strong Swiss franc. They've gone so far as to have some of the regional Swiss banks do a negative interest rate on franc deposits. What that means is those who are holding Swiss franc in Swiss accounts in Swiss National Bank, in Swiss regional banks, are getting a negative interest rate. Now, there is some speculation that Credit Suisse will drop that policy and return to the normal policy of granting depositors a positive interest rate on their deposits. We'll see if that takes place. But this is a strong move down. You can see how it literally took out 1, 2, 3, 4 days move up where we settled here, and in one swift move today took it out, but kind of bouncing off of this. The low point here would be down around that 92.10 mark. I think 92 is a very strong support level to see a possible bounce up in the dollar Swiss. Now, let's take a look real quickly at the dollar yen. The dollar yen is also at that 88.6 level. However, this is the one pair that I think we break beyond the 88.6 and we continue pushing higher. Why? Because the BOJ, the Bank of Japan, has recently provided a long-term refinance operation known as an LTRO at 0.1% over 3 years. So my thinking is, financial institutions, banks around the world can go to the Bank of Japan and they can borrow from the Bank of Japan at 0.1% over 3 years. I mean, who wouldn't want that type of interest rate on a loan? So with that policy by the BOJ, I just see continued weakness of the yen, and that alone will cause the dollar yen to rise. Now, step out and take a look at the monthly chart. This is kind of interesting. Look how far the dollar yen has dropped. At one time, the dollar yen was up around that 125, 126 area. Has pushed all the way down, bouncing off lows right around the 74, 76, 75 area. And it's trying to do a double bottom here. I think we get a break of this high point here right around the 84 level. Then we start seeing the market push up towards 85 and then higher. If you take a look at this in big picture, all the way up to the high here on the monthly, to the low that we've experienced back here, we're not even yet at a 23.6. So with a sterilized intervention by the BOJ, there's the possibility of seeing this continue to push higher, regardless of the fact that as of today, it's at an 88.6 retracement level. Well, folks, this is Dean Malone with Compass FX. I hope some of the information I've shared with you about the major pairs and their relationship to a Fibonacci retracement level and continuance of dollar weakness will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.